Before we really kick off this session and, understand what these fund managers are really, cooking in their minds, their secret sauce as to how they manage the funds and how they're able to deliver alpha, year on year. We'll definitely come to that. But yes, don't get any ideas once I said it's about the secret sauce, because yes, we're going to break to lunch next. So it's just about getting the flavors right before we, get on to the lunch part of it. So before we quickly go into the discussion, I would have, a couple of questions which are, sort of common, but they're common across the portfolios. Everyone has, you've delivered more than 30% kind of a return for the past 5 years. Yes, market has been good, but then again, it's also about the stock selection. It's also about the kind of sectors that you have in the portfolio to make it right, to create that kind of alpha. So just for benefit of the audience, if you can quickly, spend a couple of minutes on exactly what are the kind of portfolio that you're running, as well as the kind of strategies that you're putting in, in the funds at this point in time. Why we say that? Because, both Sensex and Nifty, as well as a lot of other sectoral indices are trading at the record high. So, Divam, I'll probably start off with you.
Thank you so much for this opportunity, PMS Bazaar, and thank you so much. So, overall, how we evolved, we started off very early in our lives as investors, and we've been investing a lot in our, generations of our families have been investing into markets, and we have learned the practical way all through this journey. So we are mostly value and growth investors, and our thought process has been investing in value in growing companies where value cushion is available. In terms of, we participate in the broader markets where we have, where we are not averse to investing in small, mid, even in SME companies, identifying a lot of companies early on. A lot of, if you compare our portfolios versus our peers or our competitors, you would see very less overlap of our stocks with our peers. In fact, a lot of our investments, we would be exiting when a lot of large funds would be entering these stocks. So that has been our strategy. In terms of our allocation, you would always find a cushion. We do not look at the macros from a very regular perspective. We'll definitely track them, but we at a lot of times it's a lot of stocks. It's all about stocks where if we are getting something cheap, if we are getting something where the company is growing, where there are no red flags, we would allocate capital. But at times when there are no opportunities, we are happy to sit on cash as well. So it has been a very disciplined kind of allocation strategy. Right. We play a lot of, we try and identify trends early. So we were the early adopters of Make in India, manufacture in India, China plus one kind of a strategy. At a lot of times, we also try and invest in a sectoral allocation, where the sector is is beginning to grow, where we would like to enter those sectoral reallocation kind of plays. So it has been a very we are not averse to any sector. We look at it from a broader perspective. Wherever we find growth, wherever we find good corporate governance, comfortable fundamentals, comfort of valuations, that's the kind of strategy. Overall, our allocation has also been a differentiator. We invest in a staggered manner when we are allocating capital, as well as when we are exiting, we exit in a staggered manner. If we find a red flag, we do not shy away with exiting the stock immediately as well. Also, we create a buy, sell, hold list. So in our portfolios, like some investors, we might have bought some stocks, like say 1 year back, the stock might have run up. We don't want to allocate fresh capital into those stocks. Right. So we would allocate as per today's buy list. So it's a more customized kind of allocation that we do. And at certain times we do we are open to taking cash calls. As of now, we are like in certain strategies of ours, we are sitting on even 40-50% cash on the fresh allocation. So it's a very disciplined kind of a allocation strategy. So that we follow, and I think that has clicked very well for us.
Right.
Yeah.
Absolutely. Well, rest assured, audience, we'll definitely come back to Divam and, get the insights on when to exit and when to, do the entry, the buy, sell, hold list. How do you make it? Because that is where your secret sauce is, and we'll try and uncover that in the conversation. Rest assured, audience, we'll do that. Balaji, your take on that.
Hi, good morning, everyone. So we generally continue to have a status quo in our portfolios, right? We run a mid-cap, small-cap oriented strategy. So we continue to be in mid-caps and small caps. We don't take huge cash calls. Our cash calls are anywhere between 5 to 8%. And that is also because I would have sold some position and I'm waiting to buy into the next idea. So having a cash call is a significant amount of risk. So what happens is that if gold, for example, if you take the case of gold, if gold were to go up, say 10%, everyone in the room will be uniformly happy because everyone owns gold and gold goes up 10%.
In one form or the other.
Yeah.
Exactly. It could be
physical or
physical and the digital.
Plus or minus the whatever.
Absolutely.
But if Nifty were to go up or go down 10%, 100 different people can have 100 different results.
Right.
So to be honest, I don't know if there's going to be a correction. I can't hazard a guess. But what we generally try and do is to look for companies and sectors that are growing greater than the nominal GDP growth of the country. So that is essentially happening because your per capita income is going from $800 to $2,500. And the second most important change is the women participation in the labor force. So that's showing a bit of a J curve. So what happens, when this thing changes, for example, in the furniture industry, people opt more for ready-made furniture than carpenter-made furniture, which used to be the case 20 years back. People used to, at least in South Indian households, you used to buy milk, and then the byproducts of milk were always made at home, like curd, paneer, cheese, lassi and all that. So that's all becoming very normal to buy store-made products. So value-added curd can continue to grow greater than GDP for a long period of time. So we are focusing on such opportunities, and we continue to remain invested in the markets.
Right. So over to you.
So we manage about 1,800 crores. They are in three types of products. We have arbitrage, where we take no risk. We have market neutral products, where we go long and short in equal amounts. And we have long only products, which I think is mostly the flavor we're talking about.
Right.
So we have mix of all three products in our stuff. One correction, I'm not really a portfolio manager. I would say I'm a leader of team that puts these things together. And the way we work is math and machine. So we are quants. We basically work everything using computers and using mathematical models. And our strategy or our methodology typically involves using a lot of historical information or mathematical equations, which always must be true.
Absolutely.
And that's how we build our portfolios. We build them in a diversified way. We typically don't take very concentrated bets. Our portfolios will have probably 50, 60, 70 names in the way we do it. And we are still able to generate alpha because we have a multi-factor approach.
Okay.
And at the right time, I can tell you a little bit more. I know this is an introductory question.
Right. You might be managing Team Sandeep, but I will not, let you off. And I'll understand each and every, strategy and the nitty-gritties of it. Don't worry about that. Divam, let me start off with you. If you can, yes, alpha is there, everything is there. And you did talk about the entry and exit, how you're able to, sort of time it perfectly, your buy, sell, hold list. If you can, try and give some outline to the audience as well, the methodology that, that is deployed at that point in time.
For the buy, sell, hold list.
Buy, sell, hold list as well as the entry and exit points. Yes.
So in terms of entry and
because
exit,
everyone would want to understand, acha yaar, ye kya kar raha hai? Jo humne kar something like that.
So for the entry and exit points, so it's very simple for us. We look at the when we go very deep into it's a very scuttlebutt kind of approach that we do. We like the kind of companies we buy, we've not been shying of buying a lot of small and mid caps, a lot of even very micro caps also, where we have delivered over 100 multi-baggers over the last like 5-6 years since our inception. So we go very deep. We like go visit factories, talk to the management on a quarterly basis. And when we do that, our approach is that the promoter should be good. There should be no red flag. If there's any red flag, we'll not buy it. If we find any red flag post facto, we would simply exit. We would not like shy away from delaying our decision to taking exit. And there has to be a cushion of valuation, right? So if we do not want to buy anything very expensive. If it is expensive, there has to be a reason for it. Like either the sum of parts of the business should be that much valuable that it is justifying the kind of
cutoff point there for in terms of valuations. Any cutoff point? I mean,
so like say we try and keep
how much
to the markets. We try and keep at least a 30-40% kind of a cushion to the indices, the valuations we buy. So that has been our thought process. And when we buy, like if we like the stock, we'll gradually take an entry usually. But in markets like these, you are not allowed to make gradual entries. You are actually open
flying at this point in time.
So we would actually try and take a like an entry quickly. In certain cases, times like these, we've also been approaching the companies to take a preferential kind of an allotment or these kind of things. So to get a slightly significant entry into these companies. But after that, it's a regular kind of a tracking that we do. That we try and ensure that whether the things are in the right spirit, in the right direction. In certain cases, like when the Russia-Ukraine happened, we did a stress test of our portfolios on the supply chains and other things. So any significant event that happens in the markets, we do a stress test, and our story should be intact. We are like, the idea is that if we are investing for a 3 years, 5 years kind of a horizon, at least a multi-bagger, not investing for a 10, 20, 50% kind of a return. So if some stories might get like slightly delayed, some stories might realize immediately. If the valuation exceeds our expectations, we would exit. If there is a red flag, we would exit. If the valuations are increasing and we feel that they are exceeding our expectation, we would exit on a staggered manner. And when we are exiting, the idea is like if we find a opportunity to counter that, we would like invest in those opportunities. Otherwise, we would sit on cash. Having said that, overall our portfolio, we are not sitting like more than like single digit kind of a cash we are sitting on. But in the fresh allocations, yes, we are sitting on like in certain cases, we are sitting on 40-50% cash as well for us to allocate fresh capital, because obviously with the kind of liquidity we are getting here, the kind of opportunities that are there in the markets have reduced. So definitely we would want to keep a discipline there.
Comfort is sort of not there at this point in time.
Yeah.
Live fresh capital.
Yeah. So I think especially in the kind of opportunities we are playing, keeping a discipline of allocation is very, very critical and very important.
Absolutely.
And that's what we are focusing on.
Perfect. Balaji, let me come to you. You know, you manage the small and mid cap fund, and for you, things have been moving very fast. I'm sure in that particular space. Divam said already delivered more than 100 multi-baggers, over the past few years. How are you taking those calls of entry and exit, and what are you doing when it crosses that particular valuation limit?
So Kshitij, I'm not particularly fond of labels, but for the sake of simplicity, I'm just putting this across that I would be very happy buying an average company. We're not obsessed about quality. Quality has become a very kind of an obsessive word. So if you buy an average company at a poor valuation, you can make more money than buying a quality company at a higher valuation. So the previous speaker, Rishabh, had an excellent slide. He spoke about consolidation to fragmentation in certain industries, fragmentation to consolidation in certain industries. The one respectful disagreement I have with him is that he attributed that to the per capita income changing. I am attributing that to the high ROEs. Like paint is seeing a fragmentation because ROE is getting attacked. Financial services are seeing fragmentation because ROEs are getting attacked. So my humble view is that a company that has a 8% ROE but has a potential to go to a 14-15% ROE can create greater wealth than a company that has a 40% ROE but has a chances of going to a 35% kind of a ROE levels. So these 8% ROE to 12%, 15% ROEs are found in the so-called average companies only.
Okay.
So Indian markets are dichotomous. So if you want uncertainty, the valuations will be in your favor. If you want certainty, the valuations are not going to be in your favor. I know for sure that Nestle will generate a 3,000 crore cash flow next year, but I have to pay 3 lakh crores to buy Nestle. So, where you really actually find the value is there is some kind of a problem that is not unsolvable, but it can be solved over the next 4-6 quarters. The management is trying to address that and, trying to increase the skin in the game. So that's like a big, a thing for us. So we keenly watch which are the managements that are increasing skin in the game. That can be via preferential issue, open market purchase, rights issue, and so on and so forth. Those type of companies, and if those companies are present in those sectors which are growing greater than nominal GDP, that can be a substantial wealth creation opportunity. So that's how we roll.
Looks like promoters are more or less trying to offload some stake that was point in time, and that's what we are saying, the larger trend.
Again, Kshitish, one point I'd like to make here is there is a promoter in the company can do two things. One, he or she can buy the share. Second, he or she can sell the share. Selling the share can have multitude of reasons: profit booking, philanthropy, settlement with brothers, sisters, going into a different business, and so on and so forth. True. But when the promoter buys the share, 95% of the time, it's only for one reason. It is that he or she is seeing better times in the business.
Absolutely. No deny of that. Sandeep, your take on that?
So, as I said, we are quant, so we don't really spend a lot of time picking individual reasons to either enter or exit.
Sure.
We have a process by which we score the model. We look at fundamentals and technicals and all kinds of fund flow information. We have over 130 factors we look at. So it is very difficult for me to pick out, like these gentlemen have done, this is what we do at this point. We are looking at 130 factors, scoring them on a daily basis, weekly basis, monthly basis, and an annual basis, and then putting together a portfolio which will allow us to then decide what we are going to enter, what we're going to exit.
Right.
Now, the result of that, if I may take for a second, is, let me give you two numbers. So our 5-year return is 38% annualized. Our 1-year return is 69%.
Right.
Now, if I were to ask, people would say, wow, 69% is great.
Yes, yeah.
First question is, what is the index? Right. Even if I look at the index, 1-year index return is about 41% for last 12 months. Now, 5-year index return is 21%. So I have an alpha of 17-18% on 5-year basis.
True.
I have an alpha of 28% on 1-year basis. Again, I think a lot of people here would say, that's great, you're doing very well in 1 year. But now is the trick question, and I'd love to see if somebody can answer that. What do you think is momentum factor score in last 1 year? Anybody knows?
62%.
Great. Yeah. You get this book. Please come after this. This is something I've just written. So I'm going to be happy to give you that prize. It's about 68% in last 12 months, but 62 is good.
Close enough number, yeah.
Close enough number. So if we have generated 69% and momentum alone has generated 68, 62%,
right,
it's not a great deal. Because you could easily have just picked a very simple way of putting together a portfolio. And if you had gotten it right, you would have generated very good results.
Right.
Over 5 years, would you know what is the momentum result over 5 years? It's about 30%. So it's about halfway between the index and our performance. So when we look at over 5 years, less than half of our performance is explained by just momentum. Now, a lot of quant investing in this country today is momentum investing. It is a great factor. It works very well. About 60-70% of the years, it is one of the best performing factors. But then you have a 2022 when it was the worst performing factor. So you cannot have a single factor approach And that's where we come in. We look at all these 130 factors, put it together. And that's how we decide what we're going to buy or what we're going to sell.
Absolutely. Great thought there, Sandeep. And in terms of not just PMSs, now mutual funds are also coming up with a lot of momentum-based approaches. And we've seen a couple of new fund launches that happened recently.
Yeah, I think this is one thing that I see a lot of trend. Largest fund flows in the recent few months have been in sectoral and thematic funds.
True.
They are the biggest inflows. Now, in some sense, that's just moving the problem from stock to a theme or to a sector. So you're not asking the investor to say, pick a stock, you're saying pick a sector, pick a theme, and then decide. We tend to stay away from that kind of if somebody is trusting us to say, make a decision for me in market allocation, we would give them an equity product. We'd give them a portfolio of 50 names or whatever it is that we think is the best representation without having to make any calls on which sector, which theme to follow right now.
Absolutely. Let me just quickly move from, national to international. And Divam, you have an MNC Advantage fund, which has delivered close to 45% odd returns in the last 1 year. We're seeing a lot of fears of slowdown, a lot of talk on slowdown, global slowdown, US slowdown, US Fed cutting rates by 50 basis points. That itself is a sign, or you could say is a direction that economy is slowing down, and the central banks are coming to put their foot forward and support the economy. How are you looking this international investing landscape amid all these slowdown fears that are just coming up, and it could impact India as well in the near term?
So definitely this fund has done pretty well, and we have also been seeing stories recently where a lot of these MNC companies have been pairing stakes and taking the money back home.
Absolutely.
So a lot of companies that we buy in this portfolio are not only foreign MNCs operating into India, we also invest into Indian MNCs who are operating across the globe. So the scope is slightly bigger than where we operate. And again, we try and keep a cushion of valuation. A lot of these companies are already very expensive. So we try and figure out opportunities which are slightly having a valuation cushion in the sector. So we look at opportunities broad-based in the small and mid as well. So in this space, a lot of these companies have access to a lot of global resources, access to a lot of technology, know-how, which allows them to operate well when they go across the globe. So these are slightly more efficient players, and then that's why they command slightly higher valuations. We, as at this point in time, we are looking at this. We have stopped taking funds into this portfolio. We have less of opportunities in this portfolio, and that's where obviously with the liquidity that has happened, that is coming to the markets. It has especially these kind of stories are getting a lot of capital and are getting very expensive.
Right.
And you have to be cautious when you're allocating capital. You have to be disciplined. So at this point in time, we have less opportunities, and we are keeping slightly more cash calls into this and have stopped taking funds into this scheme.
So till the time valuations come to more reasonable levels.
Yes,
absolutely. Balaji, you rated picking stocks, and you're also fond of the consumer behavior that are likely to drive the how you pick stocks and everything. So from a small and mid cap space perspective, any recent trends that you're picking up?
So one is obviously there are 3-4 examples. Shitish. One is on the automobile side. In 2008, 3 out of 4 cars sold in this country was a hatchback. And today, 2 out of 3 cars sold in this country is a SUV or a mini SUV. So in South India, IT professionals, after their 3rd or the 4th promotion, they typically buy a SUV or a mini SUV. Now there is a desire to travel. The second order impacts of roads getting better means, and the self-esteem has gone up. Urban per capita is more. You're willing to pay for safety features like ABS and airbags and all that. Then you have battery as a service picking up with companies like MG Hector. So what is happening is SUVs and mini SUVs are growing faster. So you have automobile industry growing at X percentage.
Right.
And then you have the SUV and the mini SUV manufacturers going at X plus 300, 400 basis points.
The per capita is also growing now.
Yeah. And then you have the hatchback players growing at X minus 300, 400 basis points.
Right.
So obviously, the wealth creation happens on that side. So similarly in furniture, just 4 IKEA showrooms today have a 2,500 crore turnover. So a lot of the co-working spaces are using material called as MDF, medium density fiber board, which is growing faster than the nominal GDP. At the same time, we have the plywood industry, which is growing below the nominal GDP. So we saw this trend earlier in 2010 when copper pipes, which are used for plumbing in all kind of buildings, they were actually doing well before the PVC and CPVC era took over. So PVC and CPVC started growing much faster than the copper pipe man. So similarly, you have this OTT, that is theater to OTT kind of a thing, and then desire to travel, therefore, that is also growing quite fast. So, and there's one, what do I say? I won't say it as a trend, but there is a saying that the more things change, the more they remain the same. So, some of our recent bets were actually lubricant companies.
Okay.
So, you are seeing a situation where lubricants are trying to make a comeback because of the problems that are prevalent in the electric vehicle. So you had Hertz, which is a $1 billion taxi rental company in the US, come back and scale down on EVs when they gallantly announced in 2021 that they're going to be 100% EV. They came back and said that they're going to scale down on EVs because, EVs are, not free of maintenance, etc. So your lubricants have started doing well. So these type of trends you identify and, you pick your stocks.
Absolutely, based on the trends and how the industry will benefit from that. Right. So moving from equity to debt, so let me also get your viewpoint on the debt PMS and how should one evaluate this particular theme in the portfolio?
So we have an arbitrage PMS that we have been running now for 15 years, which is our product, which is equivalent for debt. It's a monthly liquidity product. Last year, it generated 13.5% return. This year, it's already up 10%. Okay. The way we do that is by doing arbitrage in the market. So cash and future arbitrage is a big category. There's probably 80,000 crores in that category alone in mutual funds. But our returns is about 3 or 4% higher than the cash future arbitrage. Okay. And the reason we are able to do that in the PMS format is because we actually don't have the constraint that a mutual fund has, which is it has to have 65% of the money in equities for it to be classified as an equity arbitrage fund. We work with derivatives and we are completely hedged because, of course, in PMS, you can't take leverage. Right. So we do index arbitrage, we do other types of strategies which are completely hedged, but not reliant only on cash future arbitrage. So with that methodology, we are able to generate pretty consistent. We have run for over 15 years. In not even a single month we have ever lost money. We've always produced more returns than FD, somewhere around 3 to 5, 6% higher than FD returns for last 15 years.
Absolutely. Wonderful. So this is addition to, can we say it's a more of a risk-free or less risk?
Well, there is no financial risk we take. We don't take a directional risk. The markets could go up 20%, they could go down 20%. It would not impact our returns because we are completely hedged in our book. But in a product like this is technology driven. There are operational risks. There are, for example, when there was a big change in Reliance Retail or any other big change in securities in the market, you can have risk like that.
Okay.
Which can come in the operational sense, but not in financial sense. We are not exposed to markets in any direction. So I would say it's low risk.
Okay.
And the money is in FNO, so it's earning the interest rates anyway. Right. So that's how the trading produces the alpha on top of fixed income return. And that's how we are able to generate good consistent returns. But I wouldn't say it's zero risk.
No.
It's, of course, there is some operational risk built in.
Risk can be minimized, but cannot be eliminated. That's the that's rule that we all have learned in our courses or theory. So that's that. Divam, let me come to you as well. So you manage a ESG fund and it has delivered very handsome 65% return. And so how do you pick stocks in that particular basket?
So that's what we try and do. We try and incubate different strategies, and this has been very close to our heart. We call it the impact ESG. We don't call it ESG. We call it impact ESG. When we were trying to create this product, we tried and figured out various rating agencies who provide ESG ratings, and we looked at a lot of Sustainalytics and other rating agencies. A lot of them have a very small universe that they cover in terms of the ESG ratings. So we being broader market participants, we tried and figured like if there are any ratings or we could that we could leverage for this product. But eventually we figured out that there were none, and we wanted. So the idea here is that any company, like say if it is a thermal plant and it is using coal for its purpose, we would want to look at it from a standpoint that hey, the thermal and coal is definitely going to be used in India. You have to be practical about it. You cannot say that it could be 100% solar.
Right.
But the company that you are investing in has to use procedures to treat the waste and minimize the wastage as much as possible. It should be something where you are they are using as much of renewables or as much of eco-friendly procedures as possible. So you have to figure out the companies with intent to do that. Right. So when we go and visit the companies, we figured a lot of companies are taking such steps. So it's a very practical kind of an approach where we are trying to figure the companies out of the sectors. It might be if it is a cement company and it is having like some practices which are actually trying to improve the environment, actually trying to reduce the waste, treat the waste. These are the companies which we like to invest, right? And as increasingly as we are getting down and visiting the companies, we find a lot of such companies with such intent and with such practices. So we invest in such kind of companies in the portfolio. And overall, if you look at globally also, there's a big thrust in such kind of companies. There are green bonds, there are a lot of investment interest coming into these sustainability practices and ESG practices. So if you would want to invest in pure ESG companies, a lot of them have become very expensive, and on that front you would really find opportunities. But we like to do a lot of proxy investments also as a philosophy. So in ESG we are trying to figure out the practical ESG impact companies. That's why we call it the impact ESG. So and we started it as an experiment 2.5 years back. It has done pretty well, and we are very positive of taking this ahead as a product.
Right. So from ESG theme, let's move on to the small and mid cap theme, which is the hot topic at this point in time, Balaji. You are in the middle of it, and one thing which comes to everyone's mind is the valuation part of it. It screams loud valuations from every front. At this point in time, index are trading at record highs, and the kind of money that is coming into every portfolio, you have a very difficult choice to make. To put in the money at this point in time, should I, delay it, wait for a small bit of correction. But more often than not, we've seen that whenever we have this kind of thought process, the train has usually left, or the bus has moved on and the ship has sailed. So we can have many of these antidotes coming in. What is your take? How are you handling this situation at this point in time?
Thanks, Chachit. Actually, to understand small and mid caps, we need to look at large caps. I'm using Nifty 50 as a proxy for large caps.
Okay.
So here, the way I see it, the construct of Nifty 50, you're having a situation where you have 35% in banks and financial services.
Easy.
I can bet you can look at any developed market index in the world. None of the developed market indices would have such a high weight in financial services. Whether it is CAC, France, DAX, FTSE, S&P 500, no other index has such high weight in financials.
Okay.
And today what is happening is, even with those weights, there is a significant amount of non-lending financials which are present in those indices. In Nifty, you have only two non-lending names, SBI Life Insurance, HDFC Life Insurance. But in 2010, if I was a FI fund manager or a domestic manager, what are the options for me to play an AMC or a wealth management? Absolutely next to nothing.
Yes.
But today I have AMC, wealth management, low cost broking, high cost broking, life insurance, non-life insurance, stock exchange, registrar, depository. All these have been listed over the last 10 years and these are all outside the Nifty.
True.
Chemicals have created so much of wealth and there is nothing in the Nifty.
Right.
So today, what is the actual blue chips, large cap blue chips in India? It is a FANG India. Apple India has a 70,000 crore turnover. And you have Microsoft, which is 30,000 crore turnover. You have Meta, which is coming close to 25,000 crore turnover. These turnover figures are close to your Cipla, Sun Pharma, Bajaj, Hero, and all these nifty companies, right? So in early 2000s, you could just be in the top 30, 40 companies and create your wealth because your two-wheeler penetration was next to nothing.
Right.
Urban four-wheeler penetration was next to nothing. We were significantly underbanked as a population. In 2024, even India 3, if you split India as India 1, India 2, India 3, even India 3 has a two-wheeler today. Urban penetration for four-wheelers has increased. After Jan Dhan, everyone has a bank account. But the same stocks are in the Nifty. So, to say that mid and small have run, therefore should be moved to large, I find it like an argument which is like a self-fulfilling prophecy. There are a lot of systemic changes. If you look at BIS, Bureau of Indian Standards, we are regulated by SEBI, banks are regulated by RBI. The question that we need to ask is Bureau of Indian Standards trying to become the SEBI for manufacturing?
Right.
So we are now finding a situation where if you look at the non-oil imports and exports, there are many products where India is becoming a net exporter. Like cables, we used to import more cables than we export. But today we are exporting 17,000 crores worth of cables and importing 10,000 crores worth of cables. So we become trade surplus in cables. Next year we'll export more electric transformers than import.
Right.
We are seeing this in toys, we are seeing this in diapers, we are seeing it in sanitary napkins, sanitary pads. So this is kind of propelling a lot of opportunities in the mid-cap and small-cap space.
Absolutely.
And I think these are trends that are going to continue for the next 1 decade. In between, yes, there are going to be speed bumps. It's not going to be linear, but I would actually be taking more risk in Nifty.
Right.
I would say.
Spotting the behavioral trends, and that's how it'll help us to pick stocks. So a very good advice coming from there, Balaji. Sandeep, let me come to you. You talked about the arbitrage fund. What is the difference between arbitrage PMS and an arbitrage mutual fund?
I think I covered a little bit of that. An arbitrage mutual fund is classified as an equity fund, so 65% of their holdings have to be in equities. Right. So they only focus on cash future arbitrage.
Okay.
Which means they are trying to see that if there is a Reliance stock and Reliance future, what is the difference? That's what they are trading. That's how they are generating returns. That limits their ability to find opportunities. And it has become a crowded space. I think now somewhere between, I don't know exactly what the number is, but I think it's north of 75,000 crores. Right. Maybe even a 1 lakh crore is in arbitrage fund. So that much money is simply trying to make cash and future stay together. We focus on broad spectrum. So we take all Nifty 50 stocks and we say, these 50 stocks in this ratio represent one Nifty. Right. So this cannot also mathematically diverge. That's a big opportunity. We do that in BankX, Bank Nifty. We do it in Sensex. We do it in Nifty IT. So any index, we can look at what is their component, what is happening at the aggregate level, and that's why we are able to generate extra returns that I think the mutual fund industry cannot, because they are focused. They have to remain focused on that is their advantage. Absolutely. They get the equity mutual fund tax treatment. We don't. We have to pay the PMS business income tax, but our alpha more than compensates for it. Right. So that's how we kind of make that happen.
Absolutely. Well, people, I think they've given a little bit about the secret sauce that they deploy while managing the funds. You can pick their brains outside when they're having lunch. So, well, on that note, I think thank you so much for your time, gentlemen. It was lovely talking to you, and happy investing to everyone.
Thank you, Shri.
Well, thank you.
Thank you so much.